So Lemonade's Q1 letter has come out. It's a really strong quarter. As of right now, they're up about 7.5% in the pre-market. I want to give you guys my thoughts on the quarter. I just finished listening to the call, so let's dive into it. But really strong quarter overall. Everything, all of the unit economics continue to march in the right direction. Sure, there was a bit of a hit this quarter from the LA fires. Everybody has known that for months already. But the impact of that was fairly minimal in the grand scheme of things. Truly, I think a nothing burger in the grand scheme of the Lemonade story. But let's dive into a thread here. First of all, I'll review this thread that I posted on X with a whole bunch of thoughts and snippets from the call, from the letter, from the call, and then I'll dive into my model and run through a whole bunch of graphs that go a little bit deeper, even beyond what you can see right here from the letter itself. So yeah, there's a beat on IFP. It was near the end of the quarter, near the end of March, where Shai tweeted or posted that they had crossed $1 billion, and I was, you extrapolate that, it was about a 1.4 billion. They actually did $1 billion or $1.8 billion, so it's improvement there. And total customers a little bit higher, and then premium per customer a little bit lower than I was expecting. So as you see, as they move more into car more aggressively in the coming quarters and years, we're going to see premium per customer, I think, drive faster, even though you might still see total customers continue to drive because they continue to attract customers that are pet customers, renters customers, even new customers that just become car customers come in the door. But they have all those avenues, channels for acquisition, and then overall premium per customer will rise though as they cross sell. But yeah, that's great to see. Gross loss ratio. This one we weren't sure with the LA fires. I was thinking, I didn't spend a ton of time trying to estimate it, but I thought, it's probably in the low 80s, and saw something like, other people estimating that as well. So it actually came in 78%. Super awesome. If you subtract LA fires, we're at 62% loss ratio. So really great to see that. And if you take out all of the catastrophic effects, not just the LA fires, but say all of any sort of cat losses across the whole book of business, then you're at 59%. So gross loss ratio ex cat, if you look at this line here, we've gone from 63, 62, we had a 68 bump, 62, 59%. So pushing down into the 50s. And if you go trailing 12-month growth loss ratio, we're still steady at 73% this quarter over the previous quarter, even with the LA, the California fire hit. Car is a massive cross sell. They have 2.5 million customers. Well, turns out a lot of those customers have cars, and they're going to want car. And if you can price them more similarly or more accurately than other customers or other insurers, I should say, then those customers are at a high number are going to convert to car. This was also super interesting comment. They said they are finding ways to get telematic insights at or near point of sale. So they're saying in states where we have implemented this, we're seeing roughly 60% boost to conversion. So somehow they're knowing earlier whether you're a good driver or not. And if you are a good driver, well, then they can give you that better rate. As we showed at Investor Day, let me pull that up really quick. At Investor Day, they showed that if you change the price by 10%, you'll see a 50 to 150% change in conversion rate, which absolutely makes sense. Just means car business is a price competitive business. And if they can know sooner which customers are safer, then they have much better conversion rates. I was speculating, if I scroll down here, shout out to Shao. Maybe I'm saying your name wrong, but he said maybe they're referring to customers of their other products. They already have the apps, and that's a thought I have too. Maybe, I'm not sure how it works, but maybe if you're a pet customer, they're offering you like a teaser to car, and you can sign up with telematics, and it tracks you for a week or two, and then it can offer you a more accurate rate. Not sure, but that would be one way I would imagine it could play out. Then this was really interesting as well. We already knew this, but to see this reiterated again, that we should see car rolled out to several more states this year. So car was in Colorado Colorado this in Q1 was launched, but we're going to see several more states roll out. And then they said, as for regarding car loss ratio, it is higher. It's at 88%. But as they continue to file rate increases, it was in the letter here. If I pull it up, I think I had it lower down there in my thread. If I go down to the car section, they talked about they've done 24 rate increases in Q1. So whatever that is, every 3-4 days you're doing a rate increase, and that was versus 29 rate increases for car in 2024 entirely throughout the whole year. So every 10, 12 days, you're doing a rate increase, whatever it is, and now you're doing one every 3 days. And this is primarily because they're getting more and more granular in their segmentation of via telematics, and Daniel talked about that in the call a little bit as well. But jumping back to the thread, that's going to help their loss ratio, and then also as the car-based business grows and ages, we're going to see that the loss ratio come down just as they retain the best drivers and maybe even non-renew some of the worst drivers. A little comment here about tariffs, that they don't think tariffs aren't going to be a huge impact. Probably not a huge impact, and they'll, of course, adjust, all those rate increases like we just talked about with all of their products and increase their pricing as needed. LA fires, Cali fires, really a nothing burger. This was almost exactly what they told us a quarter ago. I think it was a $45 million in gross losses and 22.5 million of adjusted EBITDA losses. I think they said 20 million a quarter ago, but very, very similar to what that was, to what they were telling us a quarter previously. Revenue guide had a slight increase overall. I think the tariff situation, I think Tim made comment of this on the call, that, hey, tariff-wise, they're even in the tariffs, with tariffs sort of on the uncertainty there, they still increased their guidance a little, or their revenue guidance for the year a little bit. And I said nothing else has changed, but Matthias pointed out gross earned premium also adjusted with +3 on the high and low end. So that was some improvement there in their overall guidance. All of their premium per customers continue to increase. Cars jumping up, had a significant jump, went up another about $50 per customer. So you're talking about $4 a month, I guess, on average. Your car insurance goes up, and it resulted in a $12 million jump of IFP for car, versus $64 million overall. So that's going to keep, if you look at it before, previous quarter was only a $5 million jump, and before that there's actually a loss. Before that was actually flat. So this is a $12 million jump for car. This is significant, and we'll continue to see this climb. Pet also continuing to climb, $31 million IFP gain. That's 11% a year. That's about 50%, or 11% quarter over quarter. That's about 50% a year. Still, was growing in a similar range over the last couple quarters. And Europe also jumped, so there's some more activity going on in Europe that jumped. The loss ratio in Europe also jumped. I mean, it's a relatively small amount of the book of business. This chart here, LMND puts their own, version of it right here. And this one actually excludes growth spend, and you can see it's just a flat line, and your IFP has been soaring. In this graph here, and my own, it does still have your growth spend. So you see a little increase overall, including your growth spend increase, but versus how your IFP continues to climb, it really is a beautiful thing. Then IFP per employee continues to march higher. We're up to $800,000 per employer, and we expect this eventually. The plan is that this could go. They forecast investor that this would go as high as $4 million and be by far the best in the industry. How do they get there? Through massive, massive amounts of automation through AI, unlocked through AI. So this is truly the autonomous organization right here is this graph, your IFP per employee. You can also look at in my model, my customers per employee, another good metric, but IFP per employee is probably better because a higher IFP item like a car or home policies is probably requires a bit more complexity in managing that. Versus, say maybe a number of pet policies. You could argue it both ways, but both are good metrics. If you look at LTV to CAC, we'll also look at this on my model there briefly, but LTV to CAC took a bit of a dip even on a trailing 12-month basis. That's just because of the LA fires hit this quarter. And finally, this graph, the pink bars show your LTV to CAC conversion, how effective, the larger those are, the better that is, and then versus your growth spend. So as your growth spend really dipped, your dollars, the conversion you get for each dollar increased. But as you can see now, even though that growth spend's really increased in the last few quarters, it's still a really positive sign that the pink bars haven't completely plunged. In fact, they're similar to where they were before they really cut down the growth spend. All right, let's launch into my Lemonade model. If you want to get full access to this model and more exclusive content, feel free to join my Patreon. I will link that down in the description and above. But thanks, shout out to everyone who supports me there. Really do appreciate it. It's cool. But let's run through a number of the graphs here in my model. So first of all, LTV to CAC. So this is an estimation that I'm doing of your customer lifetime value versus your customer acquisition cost. And it took a significant hit. Now, what does this graph really mean? This is looking purely at the quarter by quarter metrics. So, and how am I calculating LTV? The LTV, I'm calculating it with this equation here. So you're using all the metrics from that single quarter. So if your gross loss ratio is worse, which it was this quarter, well, guess what? Then your LTV to CAC is also going to take a hit. So that's why that's taking a hit right there. If you zoom out a bit and you look, hey, basically you average it over a 12-month time, well, now we're not so bad. It took a little bit of a hit here. Now, if you think about it, your gross loss ratio x all cat is now in the 50s, 59%. So that if, say, next quarter, maybe we have a gross loss ratio, maybe there's not much cat exposure next quarter, and then maybe we have 3 points of cat exposure and we have 58% gross loss ratio x cat. Well, maybe we have 61%, and then that's going to have, you could really start to push this number up. This value could be now, could be over 4, and your average here could be pushing upwards again. I would not be surprised if that happened. Moving on, the next graph here. If you think about growth spend, you can just visualize here how much they're spending on growth. They told us they're going to spend this much more, and they are. And so they're continuing to make the proper investments because they have a good, solid LTV to CAC return. We just don't see that return immediately in the immediate quarter. It gets spread out over the life of the customer that you're getting. So this is again and again and again and again the thing that I think people don't understand about Lemonade, and you see analysts and Wall Street people fussing about. They say, hey, well, look how bad the net loss was. Look, they're still losing money. But that's only because they're ramping up the growth spend so significantly, and they're going to continue to ramp this growth spend. And they're doing that. I think that's the right move because your LTV to CAC, you're still going to get, that's going to return more profit later. Just the market doesn't realize that yet, or maybe Wall Street, some analysts don't realize that if you're only looking quarter by quarter and not thinking about the greater picture here. So moving on. This is a graph I added over the last few months. It was saying the present value of all customers. It takes the LTV of the customers multiplied by the number of customers. You can tell it flatlined a little bit. That's only because the gross loss ratio took a hit, and then the LTV estimation for took a hit. So as that improves and the number of customers keeps growing, this is going to keep soaring. And then, as I said, keep soaring. So if you think we're right here, this is an estimation, of course, but we're at Q1 2025 right here, present value of all customers, it's going to keep overall trend I expect is just going to keep going up and to the right as customer base grows and the LTV of all customers grows. And then this I looked at briefly in the Twitter thread, but I'll explain a little bit more. So your pink bars here is your spending on growth, customer acquisition, and you're getting so much of IFP back. And then this is versus where your sales, marketing, growth spend is. So as your growth spend has ramped up, it's very encouraging that actually over the last 3 quarters, even though this has stayed really high, this conversion has actually increased slightly. And you can think about different ways, but I've factored in an exclusion for what might be cross-sold out of this. So, regardless, though, it doesn't make much difference if you include that or not. But the overall trend is positive in my mind. As growth spend has increased, we're still seeing the marketing efficiency is maintaining its strength. Net customer growth, so just seeing the customers, how many customers not coming in the door, but how many are changed each quarter. So there would be even more than this coming in the door because some churn away each quarter. But you can see it was a very strong Q1 relative to other Q1s have been fairly weak. Maybe a weaker quarter typically, but versus a Q3 has always been one of the stronger ones. But with their marketing spend increasing and the efficiency of that, you can see where it's coming in there. Adjusted EBITDA, this again something that people might get hung up on if they're just looking at the surface. You can see there's a hit to adjusted EBITDA. It took a drop because of those LA fires, and then if you think, but if you look at adjusted EBITDA, you subtract out your customer acquisition costs. Well, again, where it still was negative versus last quarter was a positive, but I think this is going to flip back to positive over the next quarter, and probably over the next going forward into the future will continue to be positive, barring no sort of massive catastrophic event that could occur. But you pull out the CAC or customer acquisition so you can really clearly see, hey, where is the trend line of this moving? And it's basically moving in a straight line from what was peak losses now to the investments they've made, and it's going to, I think, keep accelerating up and to the right. And adjusted EBITDA trailing 12 months doesn't look quite as bad as the one which quarter by quarter. So you've averaged out a little bit, but again, I think this will continue to move upwards towards profitability. I have it adjusted EBITDA as a function of gross, as a percentage of gross earned premium, and you can see it's going to cross somewhere in 2026. Somewhere in there is where management has said, and my own forecasting is saying that they're going to flip to adjusted EBITDA profitable positive territory next year sometime. Churn from 12 months prior, this was a little bit higher, so this isn't not something they released. The management releases annual dollar retention, and annual dollar retention has increased a little bit. If I flip over here in my model, I'll just pull it up right here. So annual dollar retention was, you can see, was higher, high 80s, and now went to 84%. And if I go back to where we were here, to churn, based on that calculation, based on how the premium per customer is changing, then I calculate the churn of the book of business over a 12-month period. So this was a big deal back in like the 2020 because it was 30% basically we were figuring, and I'm like, wow, this is a major problem. But as the book of business matured, as they had more products, more places, more ability for customers to get all the products they might need and want, then your churn has come down significantly, and now we're at, we were steady at like 16% or so, 16%-ish. And now it's up to 18%. So, and that's mainly because your annual dollar retention bumped up. Now, what does this really mean? It probably just means the car rollout hasn't been as fast as we thought. It's still getting there, and it's improving, and they're showing signs it's continuing to improve, but not as maybe rapid as we thought, because and your car, as your car rolls out, that's going to, when it does, and it starts to roll out over this next year, and maybe next year, like, I have annual dollar retention in the potentially going probably back above 90%. That's because Annual dollar retention sure takes into account your customers that are churning, but also takes into account how the premium, sort of the cross-sell of within a book of business. So all annual dollar retention really is doing is measuring the premium retained in a cohort of customers over a 12-month span. So a year ago, maybe customers had so much IFP, the whole book of business, and now a year later, they have 84% of that. Now that's part because some customers cross-sold, upsold, and part because some customers turned away or canceled their policies or are non-renewed. So there's a bit of a back and forth there. For me, it's interesting that this has risen, something we'll watch, but I don't expect this. I expect it to sort of stay somewhere in this teen level would be my churn, and I expect the annual dollar retention is going to increase as they start selling more car products. Then you think about customer acquisition cost. So this is what they're paying for each customer they get. And it's been really positive. I would say it's leveled out here at this range, even as premium per customer continues to rise and your sort of overall value per customer continues to rise. And I looked at this in the Twitter thread, but we'll just look at it here. And again, your IFP is continuing to soar versus operating expenses are flat, a little bit of an increase, but that's almost entirely due to the greater growth spend. Now, your customers I showed IFP per employee in the Twitter thread. That went all the way up to 800,000. That continues its march up towards, we'll get eventually to $1 million of IFP per employee, and then $1 billion, and then whoa, it's early morning. Okay. You'll get to $1 million, $2 million, and eventually, if all goes well, up to potentially even $4 million of IFP per employee, which you're going to see. Obviously, if you think about the cost the efficiency you need to get there is going to be incredible. It's going to be incredible to see. It's really going to be the autonomous organization that has very few people operating a large book of business very effectively, probably better than even if you had more employees. And if you look at it on a customers per employee, this also continues to rise. We were at 1968 customers per employee, and now we're back up to 2020. This used to be higher. There's some various data points I had here. That's because they were a simpler business, maybe only selling primarily renters insurance back then. And now they're selling, more products in more places, and there's more complexity in that. So your customers per employee went down, and also as they sort of ramped up, the business to meet those demands. And now that's continued. Now that's we're back and surpassing where we ever were. So that about does it for me in my analysis. I'll be continuing to look deeper at all of these results and providing more videos on my channel here and on my Patreon. So thank you so much. Let me know what you thought of the quarter down below. And remember, it's in the bag.